This is VeriScope News, verified data, clear context. Today's report covers the latest release on U.S. international trade in goods and services. The data comes from the U.S. Bureau of Economic Analysis and the U.S. Census Bureau. The release was issued at 8:30 a.m. Eastern Time on April 2, 2026. This report focuses on the February trade balance and revisions to January data. All figures are presented as published. No adjustments beyond official revisions are included. The U.S. trade balance measures the difference between exports and imports of goods and services. Exports represent U.S.-produced goods and services sold abroad. Imports represent goods and services purchased from other countries. When imports exceed exports, the result is a trade deficit. When exports exceed imports, the result is a trade surplus. The United States has operated with a trade deficit for multiple decades. The trade balance reflects global demand, domestic consumption, currency conditions, and supply chains. Monthly changes in the deficit can reflect shifts in these factors. The trade balance is one component of overall economic activity. It contributes to gross domestic product calculations. It also reflects cross-border economic relationships. This release provides a snapshot of trade flows for February 2026. The U.S. goods and services trade deficit was $57.3 billion in February. This compares to a revised $54.7 billion deficit in January. The change between the 2 months is an increase of $2.6 billion. The calculation uses published rounded values. 57.3 billion minus 54.7 billion equals 2.6 billion. January's deficit was revised higher. The previous estimate for January was $54.5 billion. The revised figure is $54.7 billion. The revision adds $0.2 billion to the prior estimate. Exports in February totaled $314.8 billion. Imports in February totaled $372.1 billion. Imports exceeded exports by $57.3 billion. This difference defines the trade deficit for the month. The data reflects combined goods and services trade. Goods include physical items such as machinery, vehicles, and consumer products. Services include travel, financial services, and intellectual property. The release confirms that both exports and imports remained at elevated levels. Over the past decade, the United States has maintained a consistent trade deficit. The size of the deficit has varied based on global conditions. Periods of strong domestic demand often increase imports. Periods of strong foreign demand often increase exports. In recent years, both exports and imports have expanded in absolute terms. This reflects growth in global trade volumes. The composition of trade includes multiple sectors. Goods trade typically accounts for the majority of the deficit. Service trade often offsets part of the goods deficit. The United States exports services such as financial services, software, and education. Imports include consumer goods, industrial supplies, and capital equipment. The trade balance also reflects currency conditions. A stronger dollar can make imports less expensive. A stronger dollar can also make exports more expensive for foreign buyers. The February data shows both exports and imports at high levels. Exports reached $314.8 billion. Imports reached $372.1 billion. The difference between these two figures defines the deficit. Over time, changes in trade flows can reflect shifts in production, consumption, and global supply chains. The January revision indicates updated information was incorporated into the estimate. Revisions are a standard part of economic data releases. They reflect additional data received after the publication. Households. Trade data reflects the availability of goods for households. Higher import levels can indicate strong consumer demand. Imported goods include electronics, clothing, and household items. These goods are often part of daily consumption. When imports rise, it can reflect sustained purchasing activity. Exports can also affect households through employment and income. Industries that export goods and services support jobs. Changes in export levels can influence income in those sectors. The February data shows continued high levels of both imports and exports. This indicates ongoing activity in both domestic consumption and production for export. Prices. Trade flows can influence price levels. Imports can affect the supply of goods in the domestic market. An increase in imports can add supply. This can influence pricing conditions depending on demand. Exports can affect domestic availability. If more goods are exported, fewer may be available domestically. This can influence supply conditions in certain sectors. The February data shows imports at $372.1 billion. Exports are at $314.8 billion. The difference reflects net inflow of goods and services. Price effects depend on broader market conditions. The trade data provides one component of those conditions. Jobs and labor. Trade activity supports employment across multiple sectors. Export industries include manufacturing, agriculture, and services. These sectors rely on foreign demand. Import-related activities support jobs in logistics, transportation, and retail. Ports, warehouses, and distribution centers handle imported goods. Freight and transportation networks move goods across the country. The February data shows continued high trade volumes. This suggests ongoing activity in these sectors. Changes in trade levels can influence labor demand in related industries. Savings and investment. Trade balances are connected to capital flows. A trade deficit means the country imports more than it exports. This is often matched by capital inflows. Foreign entities may invest in U.S. assets. These can include government bonds, corporate securities, or direct investment. The trade balance reflects this relationship. The February deficit of $57.3 billion is part of this broader system. Changes in the deficit can align with changes in capital flows. The data itself does not specify these flows, but reflects the trade side of the balance. Businesses. Businesses participate in both exporting and importing. Exporters rely on access to foreign markets. Importers rely on global supply chains. Manufacturers may import intermediate goods used in production. Retailers may import finished goods for sale. The February data shows imports at $372.1 billion. This indicates continued reliance on global supply chains. Exports at $314.8 billion reflected demand for U.S. goods and services abroad. Changes in trade flows can affect inventory, production, and logistics planning. Businesses monitor these trends for operational decisions. Analysts monitor future trade releases for trend consistency. The next monthly trade report will provide updated figures. Other related indicators include industrial production data, retail sales data, durable goods orders, port activity and shipping volumes, currency movements. These indicators provide additional context for trade activity. Official data releases will confirm future changes. No projections are included in this report. The February trade deficit measured $57.3 billion. This reflects the difference between imports and exports. Imports were higher than exports during the month. The increase from January was $2.6 billion. January's figure was revised higher by $0.2 billion. Exports reached $314.8 billion. Imports reached $372.1 billion. These figures describe the scale of cross-border economic activity. The data reflects current trade flows. It does not provide direction on future changes. It provides a factual measure of February activity. The trade balance is calculated using reported exports and imports. Exports are measured as goods and services sold to foreign buyers. Imports are measured as goods and services purchased from foreign sellers. The difference between imports and exports determines the balance. If imports exceed exports, the result is a trade deficit. If exports exceed imports, the result is a trade surplus. The data is collected from multiple sources. These include customs records, surveys, and administrative data. Goods trade is based on physical shipments. Service trade is estimated using surveys and financial records. Seasonal adjustments may be applied to account for recurring patterns. Revisions occur as more complete data becomes available. The January revision reflects updated information. The calculation for February uses the latest available data. The figures are presented in nominal terms. This means they are not adjusted for inflation. The reported values reflect current dollar amounts. This concludes the latest U.S. International Trade Report. All figures are based on official data released at 8:30 a.m. Eastern Time. This has been VeriScope News. Verified data, clear context.